In 1971, President Nixon closed the gold window. This is well known by the gold community, but often the analysis of the next few decades has been very shallow, resulting in the gold community continuously crying out that the dollar has no gold backing. What is often overlooked is that the world's elite still use gold as a means of payment, and that the flow of gold is extremely important to keeping the gears of the world turning. Let's take a look at how the mechanism of gold payment works in our post-Bretton Woods world and what might cause it to fail. What has replaced the gold-backed dollar of the Bretton Woods era is a very cleverly conceived gold-backed currency that relies upon the petrodollar, the gold loan, and the futures market. It works like this. The oil-exporting nations, under the leadership of Saudi Arabia, have agreed to accept only dollars in exchange for their oil. In return, the U.S. is guaranteed to, quote, keep the dollar strong in gold. But how does the U.S. do this? Well, mining is a capital-intensive operation, and mines need cash right now in order to guarantee the flow of gold well into the future. So bullion banks arrange financing for the mines. The mines receive cash now from bullion banks in return for a promise to deliver gold in the future. This creates a futures contract in gold. The mine is a commercial short and the bullion bank is a commercial net long. The bullion bank is the market maker who gets cash from investors, in this case the oil producers. The bullion bank sells the futures contracts to the oil exporters, who are the counterparty longs to the mining industry's shorts. But this isn't the end of the story, because the oil exporters know that gold in the ground is not the same thing as refined above-ground gold. If all they were interested in was a claim on the gold in the ground, they could simply buy mining shares outright. But that's not what they want. They want real gold. So how do they guarantee that real gold stands behind the futures contract? That's where monetary authorities come into play. They have large stores of official gold, which they in turn loan out to the bullion banks in the form of gold loans. These loans are of finite term and stipulate that the bullion banks return the gold plus interest at some point in the future. This isn't a transfer of physical gold, only a transfer of title. The physical gold stays put. The bullion banks can pay the interest because of the contango on the futures market. If you're not familiar with contango, it is simply the condition where the future gold is priced more highly than spot. It is the way that entities that are willing to warehouse a good can generate a profit, but more on that in a minute. So in this way, the monetary authority can maintain physical possession of the gold and provide assurances to oil exporters that they can get their gold if they decide to stand for delivery on the futures contracts. And voila! What has been created is a paper contract that acts as a warehouse receipt for gold that has the backing of the U.S. government. Does this sound to you like what the dollar used to be? It does to me too. In fact, this is real power money. This is the currency that holds everything together. The gold-backed dollar hasn't died. It has only changed in form. What is needed to keep everything functioning properly is this system I have circled here in blue. It requires that we have bullion banks who can make the market between the oil exporters and the gold miners. It requires that the miners can make a reasonable profit and are willing to hedge their future production. It requires that the monetary authorities are willing to make gold loans. And for several decades, this has worked. So what can cause it to fail? One possibility is that the miners find it difficult to make a profit with the prevailing price available in the futures market. This could happen if the costs of labor, fuel, or equipment climb and put a squeeze on profit margins. It could happen if the gold available in the ground becomes harder to extract as higher grades are exploited. I've shown in some previous videos that ore grades are in fact declining, which means that gold is in fact becoming more expensive to mine in real terms. We can also take a look at the current share prices of gold mining companies, which are very depressed relative to where they were a few years ago. Another possibility is that the bullion bank is unable to make a profitable market in the futures pits. If there is some doubt about the ability or willingness of monetary authorities to guarantee the delivery of future gold, then the price of future gold will decline compared to spot gold. Without a significant markup for future gold, then the bullion bank will have no choice but to stop taking loans from the monetary authorities and curtail the production of futures contracts. There is evidence to suggest that this is happening now. Last year, when Germany announced it wanted to repatriate its gold from the New York Fed, they had to accept terms that delivered the gold over a 7-year period of time. And still, the repatriation is well behind schedule. This strongly suggests that even if the gold is physically in the vaults, it is encumbered by gold loans and not available for delivery. We can see the effects that this has had on the price of various gold futures contracts. What I'm plotting here is the profit incentive that is available to be shared between the monetary authorities and the bullion banks. These are the premiums over spot for various long futures contracts. You can see that the near-term contracts are in a condition called backwardation, which is where the future price is lower than the spot price, while further out contracts are in contango, which is where the futures price is higher than spot. Even for longer-term contracts, there isn't much of an incentive for a bullion bank to act as a warehouse. For example, if a gold future is sold for delivery in 2 years, the premium over spot is only about 1.5%, or less than 1% per year. This means that in order to justify underwriting the contract, the bullion bank will have to pay for warehouse storage space, employees, pay the lease rate on the gold to the monetary authority, and pay shareholders a dividend, all out of a spread of less than 1%. This isn't doable, so it's not worth writing the contract. To make matters worse, with near-term contracts in backwardation, it makes more sense to sell metal on the spot market and buy a futures contract for future delivery. If the bullion bank could guarantee the return of the metal, then this would represent a risk-free opportunity to earn a profit. So why aren't the bullion banks doing this? Well, the only possible reason is that there is nervousness in the market that the futures contracts will be honored by real metal. And so let's take a look at what's happening in the futures markets as detailed by the Commitment of Traders reports. On this graph, I'm only showing the commercial long and commercial short positions. The commercial shorts are generally the mines. The commercial longs are the ones who are buying the futures contracts primarily for future delivery of the metal. What you can see is that for a decade, about half of the mine supply has been hedged in the futures market. Between 2004 to the peak of the market in 2012, the mines gradually sold more gold forward. This made economic sense because as the price rose, the incentive to lock in a good price for the metal also rose. But after the market peak, the number of commercial short contracts went into a steady decline. Part of this was due to declining gold prices. Part of it was due to the reduced incentives available to make a profit off of the contango available in the futures market. There is more emphasis now upon current gold than future gold. This is not to say that future gold is not still in demand, as is evidenced by the relentless increase of the number of commercial long contracts, only that investors are now placing less faith in the futures contracts than they are in current physical gold. But even still, future gold that has a possibility of delivering is better than no gold at all. Right now, due to declining commercial short contracts and rising commercial longs, we are facing a fairly unique situation. The mine production that has been secured through hedges is essentially cornered. Each commercial short is matched almost 1-to-1 with a commercial long. Hedged mining supply is essentially spoken for. No new power currency can be created without one of two things happening. First, the monetary authorities can start selling their own gold. What is not already encumbered, though, is too precious. The Treasury already flatly stated that it would not sell any gold, even to keep the government running in October. Second, mines could put on more hedges, but without a substantial rise in the gold price, this seems very unlikely. And so we're faced with a couple of possibilities. Either the gold price rises substantially, or the futures market breaks. In the case of the latter, there will be no more backing of the petrodollar by gold, and the price discovery mechanism will stop functioning. In this event, gold will stop flowing altogether, as will oil. But both will be priceless in dollars, because the value of the dollar truly will go to zero.